welcome to your Daily 5 for the 9th of November. My name is Julius de Kempenaer and I am presenting to you from Amsterdam in the Netherlands, and I am hosting today's episode of your Daily 5. I am a senior analyst here at Stockcharts.com and the creator of relative rotation graphs. And of course, they play a crucial part in my approach to pick 5 interesting charts for you. You can find my contributions in the RRG blog on the site, as well as on Stockcharts television, where I host Sector Spotlight every Tuesday from 10:30 to 11 a.m. Eastern. For this episode, I want to take a longer-term approach. And this week's episode of Sector Spotlight, I talk about the sector rotation model, which you see on the right-hand side of the screen. And if you're interested in how that works and my view and the updated elements of that chart, then please check out this week's episode of Sector Spotlight. For this version of Your Daily 5, I want to dive into 5 particular charts that I think are sending us a message, a longer term message with regard that we can interpret to gauge the direction of the stock market. And the first one that I want to check out is the relationship between growth and value stocks. I talk about that every now and then, and the chart that I use for that is the chart that you see on the left-hand side of the screen, which is the Dow Jones US Growth Index compared to the Dow Jones US Value Index. And the mountain chart that you see below is the S&P 500. Now, by simply looking at that blue line, which is that relationship between growth and value, I think we can all agree that a massive head and shoulders pattern has been completed and that we have recently confirmed that downtrend when we broke below that May low that was set a couple of months ago. Based on the height of that pattern, we can sort of peg a target around that is 115 roughly in that ratio. And if you look at the area of the S&P 500, that would bring us back to S&P levels around that were seen in 2018 and 2019, which would be somewhere right here, which is just below 3,000. Now, the correlation right now is really high, but it's not always the case. And you really want to use this relationship when the correlation is high. And that's why I have plotted the correlation between that ratio and the S&P 500. And as you can see right now, we're at 85. That is a pretty high correlation for this relationship. So my take is that it is a reliable indicator and it is sending us a warning signal. Because usually when markets go up, you want to be in growth. When markets go down, you want to be in value. And right now, this relationship tells us that we should be in value stocks. If we move on to the second chart, that is the one that is looking at the relationship between consumer discretionary and consumer staples. And that's an interesting one because that's a sort of a risk-on, risk-off indicator. If you look in the sector rotation model and you look at where discretionary is and where staples is, then you can see that discretionary starts to outperform right at the bottom of the market. The orange line here is the stock market. And consumer staples start to outperform just after the top of the market. That's when investors are seeking safe havens. So looking at the relationship between discretionary and staples makes total sense. And if we look at that relationship right here, then we can see that that is rolling over and breaking important support levels, which is confirming the weakness of the market in the S&P 500, so confirming the weakness of the S&P 500. And if you look back, you can see that every time that this ratio rolls over, you're looking at a very decent decline in the market. Here was sort of a limbo period, but when it really started to roll over, we had that big decline 2008. We have a few of those situations on the way up. Then there is the weird rotation that led to the 2020 decline, the COVID decline, which was signaled right here. We had a little bit of an uptick in the market and then we went down. And now we have started to decline here right after the market has stopped. So basically that is confirming the underlying weakness of the market. And looking at this chart, it doesn't look as if this is going to bottom anytime soon. Now, one of the macroeconomic indicators in the sector rotation model, because it should not only look at the sectors, but there's also a number of macroeconomic factors that are super important to back up what we see in the sector rotation model. And one of them is interest rates. And they are rising rapidly, and you can see that right here. And I think that this is a very telling chart. We are in this is 10-year yields in the US. We are breaking out of an almost 20-year downtrend, and we're doing that with a vengeance. This is an unprecedented move. If you would plot the rate of change of this move, it's off the charts. So those rising rates are signaling that the economy is in full recovery, which would position the stock market past its top and in a bear market. And the question is how far it will go. We'll have to wait and see, but this is a very important move. This is not something that is going to be reversed very lightly and anytime soon, I believe. So this is also a chart that is underscoring the current risks in the stock market as it is today. The fourth chart also backs up the position in the sector rotation model. It's the one of the yield curve. And if you look at the yield curve right now, this is a chart that goes back to 1990. Every major inversion, we're talking about major inversions, not necessarily like a dip like we saw here in 2012, but looking at the major reversions, 1990, 2000, 2006, and right now. And as you can see, we had a pretty serious decline every time when the market inverted. And that is what's currently going on. We had a little bit of an inversion right here. It wasn't enough. We had a bit of a dip here, but right now, this is a record inversion. This is higher than the last 20 years. So I'm going to take this very seriously and take the approach that we are already declining, but the question is it enough, and when is it enough? And I think what we need to look for is when the yield curve will start to move back to normal. So basically start moving back up, and when it goes above zero, that's when we start to steepen. When we have a flat yield curve, when we start to steepen, that's when usually stock markets will respond with a move higher. Now, how does that translate into the sector rotation? And for that, obviously, there's no Your Daily 5 from me without an RRG. And I'm using the equal weight version of the RRG to make that pretty clear. What you can see here is that energy is rolling over. It was the leading sector, but it's now rolling over. And that is what's happening at the top of the market. And if I take this one out of the equation here and I concentrate on the defensive sectors, then you have utilities that is moving further into the leading quadrant, losing a bit of relative strength, but still at very high levels. You got the consumer staples sector, which is right here. So we've got utilities, we've got staples. They are moving further into the leading quadrant, but more importantly, we have healthcare, which is right here, that is starting to push into the improving quadrant towards leading. All in all, I do believe that there are enough reasons, and these 5 charts will confirm that, to be very, very cautious with the current state of the US stock market. And that concludes my 5 charts for Your Daily 5 today. Thank you for watching, and I hope to see you again at a future episode of Your Daily 5 here on Stockcharts Television.
Hey, Grayson Rose here with Stockcharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.